Right, today I'm talking about get mortgage ready for right to buys. Now, as everybody knows, right to buy is the council scheme, and up until the 20th of November, the discount was a certain amount, and then from the 21st of November, it's changed. Now, a lot of people did apply at that point, and then after that, they've been getting the Section 125s, some have been getting valuations, and there's a lot of things going on. So I thought I would just answer some of the common questions that I'm getting. And then, obviously, if anyone else is getting questions, if anyone else has questions as and when, I'll have a look at the comments and answer them as I go. So the first thing is, what is the order of things? Now, originally, or the majority, I would like to say, would say that it's you fill out the RTB1, and then you get the RTB2, then you get the valuation, and then you get the Section 125 if all goes well. But some people have been saying to me that they're getting the valuation before the 125. Some people are saying before the RTB2. Now, basically, the RTB2, I don't think that is as relevant so people don't need to be concerned if it goes straight to the valuation. I think a lot of councils, they are overwhelmed by the amount of people that are the amount of applicants that they were getting. And obviously at the moment, a lot of people are saying they applied back in November and it was meant to be 4 weeks and they've heard nothing. But if you think about it, if 10, 20, 30 times, or even 100 times more people applied because of the short deadline, there will be a backlog. So I wouldn't be concerned. If it's on them to get back to you, that's not a problem. Just make sure you check your email, you check your junk mail, and, just keep an eye on things. Make sure you've got all the documents that they need and you send them back in a timely manner. So make sure that the onus is with them to get back to you rather than vice versa. Now, at the end of the day, there are a lot of things to think about when you're getting mortgage ready. And as I say, I have got a course that I've been doing, and it's been really interesting actually to figure out what kind of things people are asking and what kind of sort of questions that are coming up on these sessions. So the first session was on the whole right to buy process, and it asked a lot about the discount, how to read a Section 125, and that kind of information. I do go in on the course, I do go into it in a lot of detail, but for now, what I'm going to do is I'm just going to briefly go over it. So, for example, when it comes to the discount, the way the discount works is when you're calculating the discount, what they will ask you for, or I think the majority of those websites are down now that were calculating the old discount for you. But the information that they were asking for was things like your postcode, whether it's a house or a flat, and what you think the estimated value of the property is, and how long you've been a tenant. Now, with the council tenant, it is cumulatively. So if you were a council tenant at a previous property and now you're a council tenant at this property, you would add them both together. So in this instance, it's really, really good when you have your credit report, because your credit report is a good way of showing where you lived at what point. Because obviously, if you applied for a credit card at your previous address, it would have those dates. And then if you applied for a credit card at your most recent address, then it would have those dates. The other good thing is maybe check your online current account, because when you look, then you can download bank statements, and the old bank statements would have your previous address and the other one would have your new address. So that really, really does help when it comes to that kind of information. So once you've calculated the discount, then you know roughly what to expect when that Section 125 comes through. Now, when the Section 125 comes through, you really, really need to read it in detail. And as I said, if you get it and you're not sure how it works, or you want someone to sort of go through it with you, by all means, DM me and we will go through it. That isn't a problem at all. But generally speaking, the information that will be on the 125 is one, what the market value is. Now, a lot of people have said to me, how do I work out this market value? Now, the best thing is to look on Zoopla and get a rough idea. But Zoopla is, you have to go to house prices and try and find a property that's exactly the same as yours, on the same street or within the same postcode, that has sold within less than 6 months. And then generally speaking, I've been told that people will downvalue it slightly. But what you can do is ask an estate agent to give you a valuation. I know clients in the past have pretended they're selling and asked an estate agent to give them a valuation, because if you're selling, it is for free. And then once you get the valuation, you obviously have to tell the estate agent you're not selling anymore. But it really is what you feel comfortable doing. But once you get an estimate, that's the first figure at the top, the market value. The next figure would be your discount, which we've already talked about, going on the discount calculators, working out the discount, and that gives you what the amount is, what the property's worth, the property price, the PP. Now, when you're applying for a mortgage, unless you've got money that you're putting towards it, then the best thing to do is try and find a lender that will do 100% of the deposit. There are lenders out there that will. And at the end of the day, you can get up to 70% of the property off. So when you're talking about loan to value, and that's the difference between the actual market value of the property and the loan, if you think about it, if you're getting 70% off, then the loan is 30% loan to value, because the actual market value is obviously the 100%, and you're getting 70% discount, which is the deposit, so the loan is actually 30%. Now, if you want, the reason I'm explaining this is, if you want additional borrowing for home improvements, some of them will go up to 60% loan to value. So if you think about it, if you're on 30% loan to value because you've got a 70% discount, then that additional 30% you could actually borrow in order to do home improvements. Now, this all does depend on affordability. So basically, when you're looking at affordability, back in the day, it used to be, I'm on 20,000, and they would give you 4.5 times your salary, so it's 4.5 times the 20,000. But they don't do that anymore. As responsible lenders, they now look at more things than just that. So what they're doing is, let me turn this up, sorry. Hopefully you can all hear me okay. If you can't, please let me know. And the next thing is, if you put in the comments if you can't hear me, just let me know. I'm hoping, or give me a thumbs up or something, so I know that you can all hear me. That would be great. So the next thing is, I'll look at if just one of you can just say you can hear me. That would be really, really good. Right. So okay, cool. Thank you. Right. So the next thing to be concerned about, or to think about, is when you are working out affordability, and I'll just run through this very, very quickly. You've got your income. Now, there are several different types of income. You've got the standard employed income. Employed income would come with overtime, maybe commission, depending. So all of that information is there. Maybe you get some kind of benefits from your employees. What I am, as an employee, what I mean is like your health benefits and things like that. A lot of things can be added on for affordability, just to let you know, like your car allowance and things like that. A lot of that can be added on as an employee. Then the second thing is self-employed. Now, self-employed can be split. You can have self-employed as a limited company, and you can also have self-employed as a sole trader. If you've got it as a sole trader, then it is your SA 302s. And if it's as a limited company, then it's dividends, director's salary, and or retained profits. You can use one of those three or a combination of, depending. Now, if you, and I was speaking to someone previously, if you started off as an employee and then you went as self-employed, or if you were self-employed and you went from a sole trader to a director or vice versa, that is all continuous employment. As long as it's in the same sort of business, the same type of thing, you can use that as continuous employment. So that is something else to be aware of. The next thing I wanted to talk about is if you're on benefits. Now, some lenders are saying the employed or self-employed element, so earned income. So earned income is employed or self-employed. Benefit income is unearned because you're getting the benefit, but you're not actually working. So what they will say is 50% of your earned has to be, so your whole income has to be 50% earned. And then, so if you've got benefits that are more than your earned, you cap it at the 50%. So that's what some of the lenders are saying. So it really does all depend on affordability. So basically, those are the couple of things that I wanted to go through. Also, improving your credit is very important. So when you're getting mortgage ready, so all of those of you who've done the RTB1 and you're waiting, now is the perfect time for the Get Mortgage Ready, which is why I've been running workshops, and I'll put a link in for you guys, but it's also in my bio. But it's really, really important to get mortgage ready and use the time you've got while you're waiting to get mortgage ready. So at the end of the day, the first thing is, to understand the right to buy process. By understanding that, you know the pros and the cons of it all. And I said to everybody, apply, because it's the discount, but you do need to weigh up whether it is the right thing for you to do. Even though you've applied, if it's not the right thing to do, then, have that conversation. The next thing on with the workshops is, one is the whole right to buy process. Really important that you know that. The next thing is credit. So I did a whole workshop on building credit, improving credit, and repairing your credit. And simple tips are, get yourself on the electoral roll, have a credit card that you pay off in full every single month. Basically, and I do financial coaching as well. I'm a mortgage advisor, so obviously I do mortgages for people, but I'm also a financial coach, and the credit is where the financial coaching hat really comes into play, because you have to look at, if you are in debt, which debts you pay off, how it affects the mortgage. This kind of comes hand in hand. So that's why it's really, really useful to understand. The next thing is, the last session that I did was on mortgage preparation. So it is really about the essence of getting mortgage ready. So things we talked about were, one, mortgage knowledge and mortgage jargon. So I talk about, what a fixed and variable is, and when you would want to go on a variable, when you'd want to go on a fixed, when you'd want to go on a tracker, and what the different types are. The term, so you've got the term to retirement, so you've got the long term of the mortgage, and then you've got the deal term. So that the initial term, which is the deal, so 2, 3, 5 year fixed, and then you've got the term, which normally is to retirement. You can actually get 40-year mortgages now, which couldn't back when I first got my mortgage, back when I was in my 20s. You could only get 25 years, but you can actually get longer if you've got that age. Now, the length of the term does really determine how affordable it is on a month by month. So when we're talking about affordability, I've always talked about affordability and, your credit commitments and your income, and that works out how much they will lend you. So that is the first part of affordability. But the other part of affordability is, can you afford it every single month? Obviously, with right to buy, your rent is very low. The mortgage won't be as low. The only, the benefit obviously is you're no longer paying somebody else. You're actually paying off your mortgage. So eventually you will own the property outright. So, I mean, at the end of the day, you need to weigh up whether paying more per month, one, is it affordable, but two, how do you feel about it? Like, for example, I was talking to a client and they're like, I'm happy to pay double what I pay as rent because I will own this and it's something I can give to my children. So everybody has their opinion on whether they should buy or whether they shouldn't. I'm assuming because you're on this call that you're considering that. Let me do some of these questions. All right. Okay, so the first question, I've applied for a council place before the discount, but still they have not said anything. Yeah, again, there's a backlog. I think you can contact them and just try and get updates, but over Christmas and New Year, they're probably going to ignore you. So, as soon as it gets to early next week, definitely contact them. Also check junk mail and things like that. The next thing is, what should you do if they don't get back to you within the time frame? I have done a video on this, and basically I think it's the RTB6, and that one is where there's a delay, you can actually dispute it. I mean, there's kind of a 50-50. A lot of people are saying they weren't expecting this deadline to hit, so the longer the council takes to get back to them, the more time they've got to improve their credit, B, get mortgage ready, and do all that good stuff. Some people have concerns because of the stamp duty exemption. For first time buyers, the stamp duty exemption, which is the tax that you have to pay when you buy a property, with first time buyers, they've said that as long as your property is worth less than 425,000, you don't have to pay any stamp duty. But then from the 1st of April, so you've got to have completed by the 31st of March, and completed, I mean, gotten the mortgage, the legal exchange has all happened, and it has completed. All of that has to be done by the 1st of April, because up until the 31st of March, the stamp duty is 425,000. From the 1st of April, it is only 300,000. So that is a difference of 625,000 that you'd have to pay if your property, is worth the 425. So for example, if your property is worth 425,000, if you complete by the 31st of March, you don't have to pay anything. If you complete on the 1st of April, it costs you 6,250. So that's something to be aware of. So you've got on the one part, people are hoping it will get delayed because they really want to get mortgage ready, even maybe save up some money so they can put towards the discount and things like that, improve their credit. Maybe people haven't been working in a job as long as they would like, or things like that. Also with April, that's when the tax is due. So if you're self-employed, you may be looking to put that tax return in for the affordability and everything like that. But then on the other side, because of stamp duty, if you are in that bracket, you're thinking you want to complete as soon as possible. So pros and cons, really. I've applied for a council place before. Yeah, I've answered that. Right, so someone's saying they've had the council place just over 3 years. Will they get the maximum discount of 136,400? You need to check the calculator. 136,400 is the maximum you can get. Just over 3 years is literally the lowest discount you can get, and then as the years go on, it keeps on going up and up, and then it gets capped at 136. So even though it says it's capped at 70% of the value of the property, if that means that there's a discount of more than 136,000, presuming you applied by the 20th of November, then that's what will happen. But based on just over 3 years, you really do need to check the calculator. The 136 is the maximum. Do you have to accept the council's valuation? No, you don't. Basically, the way it works is there's a district valuer, or you can get a private valuation, or as I said, you can get a surveyor to give you a private valuation, or you can get an estate agent to give you a valuation. And or you can do your own research on Zoopla or whatever. If you feel that it's not enough, then what I would recommend is you feel they've valued it too high, I should say. Obviously, you want it to be valued as low as possible, because obviously, and then with the discount, you end up it's cost you less to buy the property. If you're not happy with the valuation, then I definitely dispute it. I know some people that have disputed it with the district valuer, and they've been given an extra 12 weeks to get it sorted out. So if you are on the delay tactics team of things, then going to the district valuer is probably a good thing, and they can give you an extension, but it really does depend. The other thing is, I've heard differing points of view. So some people have said they literally just got a call and it was valued, over the phone. Someone had a sheet and they basically said, okay, based on it being this postcode, this spec, i.e. 2 bedrooms or whatever, this is what we're going to value at, end of, and they've moved on. They haven't actually physically gone and seen the property. Some people have physically been and seen the property, and the property has had a lot of work done personally by you, even though it's been put on the forms and they're meant to value it as a shell. They've been influenced by the fact that the property looks as nice as it does. So again, they're disputing it. But yeah, district valuer is the way to go, or the others that I've suggested. Right. Someone keeps on putting in the same comment, but anyway, hopefully that's good now. Um, uh, oh wow. Okay, that's quite a few times the same question. Yeah, if the market value is 300,000, if we're talking about the stamp duty, um, yeah, if you're talking about the stamp duty, then basically that is based on what the property's worth, not the market value. So it's after discount. It's what you're paying for the property. 136,400, if you applied the 20th or previous, is the maximum. It's the absolute maximum that they will give you as a discount if you live in London. If you live outside of London, it was 102,400. But obviously, anything from the 21st of November onwards are different rates. Um, is it advisable to go via the bank or a mortgage broker? Right. Now, it is really up to you. Obviously, I, as a mortgage advisor, would say go to a mortgage advisor. And I'll tell you the reasons why I would say that is because, like myself, I'm directly authorized, which means I have access to all of the high street banks and the majority of the specialist banks. When you go direct to the bank, it's difficult for you to know which bank to go directly to. A lot of people, a lot of people go directly via who they've got a current account with, but they may not be doing the best mortgage deal. If you go to a mortgage advisor, at least they can search the market and have a look at all the banks, building societies, and tell you what is the best that is on offer. Going direct, yeah, I mean, at the end of the day, if you go via, like myself, I ask for 3 months bank statements. If you go via your direct bank account, they will have your whole history of the last 20 years. So it's a personal preference. Do you want them to just look at the last 3 months, or do you want to look at everything that you've ever done with that bank? So yeah, it really is whether you want the opportunity to go to other lenders. At the end of the day, your bank, it used to give you loyalty for going to them when you've got a current account with them, but now it's like the lenders, it's a very competitive market to get your business. So there are lenders out there that, you wouldn't have a current account with normally, even some of the building societies, and they will offer you certain incentives, cashback, which is on completing the mortgage when you get money back that can be put towards legal and stuff like that. They will offer you that kind of thing, or even free legal just to get your business. So if it was me personally, I would always shop around. The other thing is, everybody has their expertise. By going to a mortgage advisor, they know their stuff, or they should do. So, depending on your criteria and your circumstances, they can actually guide you and say, you know what, this lender isn't probably offering the best rate there, but they are willing to accept all of these criteria, which means it boosts your affordability how much more. And it's those kind of conversations that you can have with mortgage advisors, and that's why I prefer to say mortgage advisor rather than mortgage broker. Mortgage broker just obviously is a broker, so they broke the deals, where a mortgage advisor, not only do they give you advice, but they also broke the deals, so they do a combination. So as you've seen from all my videos, I really like to educate people so they have a full understanding of how things work. So that is why I would say a mortgage advisor all day long, because they can give you all the information that you need in order to make an informed decision, and you can have conversation with them. You can talk about your circumstances till you feel comfortable and you understand how it all works in order to do that. Okay. Do, 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 do. Okay, sorry. There's quite a lot of questions here. Right, how does a remortgage work? A residential remortgage to a buy-to-let one works. Can you do this after a few years? Right, so right to buy, let to buy, which I've done for quite a few of my clients. So at the end of the day, say that you buy a right to buy property and you get the 70% discount. So your loan to value, so that's the value of the property compared to the loan, is only 30%. And then your pre-exempt period, which is the period the council sets before you'd be able to sell the property or rent it out or do whatever you want to, is 3, sometimes 5 years. Now, after, say, for example, those 5 years, you know, your property does go up in value, but it's still only 30% loan to value. Now, you can borrow up to 75% of the value of that property based on rental income if you turn it into a buy-to-let. So in all intensive purposes, what you could do is, if you only have a loan of the 30%, but you can go up to 75%, that extra 45% you can borrow, and you can use that as a deposit for another property. So you could rent out your council property and buy somewhere else. Now, you're now buying with a 45% deposit. Now, the 65 that you have to find will be based on your affordability, so you know, your income, but the 45 deposit is being funded by the first property, which is being covered, the mortgage is being covered by rent. Now, I am doing a bonus video as part of the series explaining this in detail, but I've done it for quite a few clients, and it really is a good sell, because a lot of people want to buy their council place, but they don't want to live there forever. This is the perfect scenario. You buy it, keep it for the 3 to 5 years, whatever the pre-exempt period is, turn it into a buy-to-let, rent that place out and buy somewhere else. So yeah, it's definitely a good idea. Right. Okay. Yeah, that is a lot of applications. So someone's saying how many applications that one of the councils do. Only 4 officers to deal with it. Yeah, there will be. As a single mum on benefits looking for a job, would you be able to get me a mortgage? It really does depend on affordability. At the end of the day, it depends where you live and what your benefits are. When you say you're looking for a job, yeah, again, it depends. If by the time you're mortgage ready and you've got the section 125, you can actually you know, you've already got your job and you've got 3 months pay slips, then some lenders will allow it, and you just have to go from there, really. Being a single mum, not to be rude, but they won't really care. It's all about affordability. No one's going to judge you as a single mum. They're just going to be literally look at our affordability, and where do we go from there. Benefits, obviously you've got child benefits, depending on the age of the child, and things like that. Really, again, it's just down to affordability. No one's going to discriminate against single mums. They're just going to have a look at your affordability, and obviously if you have dependents, that can reduce your affordability, but then if you've got child benefit, that will increase your affordability. So it's all about affordability. Do they have to take? Yeah, that is, there are so many different benefits that they will take, and I think that's um, a separate conversation. So if if you want to DM me and we can talk through your affordability and the different benefits and what the likelihood is of what the property is going to be worth, I can tell you genuinely. I've sold my house and the valuation. I have sold my house and the mortgage valuation is done. I'm not sure if the buyer is doing their own. Right, I don't understand that question. But if you want to DM me and we can talk about it individually. Right, so mortgage valuations. Now, with mortgage valuations, this is the order it is. So you decide on what mortgage you're going to go for. Your mortgage advisor, or if you go direct, the mortgage advisor within the bank will do your mortgage application for you. Once the mortgage application is done, it goes to the underwriters team. At that point, they will book a valuation for you. Now, I say valuation, but survey. So there are 3 different types of surveys. They will either book a plain valuation, which can be done either as a desktop, i.e. on computer, like a Zoopla type thing, or a drive-by. They'll just drive past the property, and it's like a one-pager. You don't get any information on it. You get the home buyers report, which is more of like a traffic light system, and green is good, amber is minor, and red is major. Or you've got the full structural survey, which is what I've personally done with all my properties, and that gives you a very thick report that details pretty much the whole of the property. So it really does depend, but they book the valuation. It can sometimes take a few days, or it can sometimes take a couple of weeks depending on the demand. But at the end of the day, while the underwriters are looking at the application, and then the underwriters may have queries or ask for certain documents like 3 months pay slips, 3 months bank statements, ID, that kind of stuff. While they're reviewing all of that, the valuation is also being done, and on the assumption that the underwriters are happy with everything and the valuation goes through, that's when you get your mortgage offer. So this isn't to be confused with the valuation that the council does, because what the council does is they will do a valuation before they give you the Section 125. They're 2 different things. The lender, the bank, building society, will do its own valuation because it's lending you money and it wants to know that the property it's lending you on is worth it. And then the council also want to do their own independent valuation, because at the end of the day, they want to, work out what they're selling you the property for, minus obviously the discount being the purchase price. So I hope that answers that question. Right, when the district valuer comes in, so if you appeal it and the district valuer goes higher than what the council said, I honestly don't know. You'd have to speak to the individual council to find out which one you have to go with. Yeah, I genuinely don't know. It does differ from council to council, so you really do need to double check your stuff before you do anything like this. Yes, they're meant to reply within 4 weeks, but as we've been saying, because of backlog, Christmas, New Year, there are delays. You cannot use the right to buy discount to pay stamp duty. They're 2 different things. So basically, the discount will come off the purchase price in order for you to purchase it, but the stamp duty is a tax that you pay. So the stamp duty is something that you have to pay when you're going through land registry, and it's normally the solicitor that calculates the stamp duty due, and they will take the money from you in order to cover that. But the actual discount, which is being used as a deposit, it'd be like double counting. So if you've got this discount that is reducing the value of the property, you can't then use that. The discount is literally discounting the value of the property in order for you to purchase it. It isn't like a sum of money that you can use for whatever you want. So it can't be used for legal fees. It can't be used for stamp duty. It can't be used for anything like that. I hope that makes sense. Right, yeah. So the stamp duty is based on what the property is worth, so the property price. Someone saying that they applied the first week of October and they haven't heard anything. I mean, by all means, send an email and chase it up. But I don't think this time of year between Christmas and New Year, I think all the councils are closed unless I'm wrong. So it's just keep an eye on the dates, check your junk mail, and send emails, and hopefully you'll hear something soon. Good evening. Uh, is a property. Someone I know lives in the property that is on a buy-to-let mortgage. Are they likely to be caught? I don't know. I don't know. I don't know. Um, council accept right, RTB1. Should I? Right. Okay. If the council have accepted the RTB1, it might be worth going to a mortgage advisor. I mean, I'm getting a lot of inquiries, and I'm starting to work with people to get the mortgage ready. So from applying, doing the RTB1 up until getting the Section 125, it could take several weeks, maybe a couple of months. That's the perfect time to start getting mortgage ready. If you don't understand what that means, then obviously I've got my course, but you can talk to me individually, or you can sort of talk to other mortgage advisors are available. Um, a repossession from 13 years ago stop you from getting a right to buy mortgage? I don't think so. I mean, repossessions are normally on yeah, I mean, the only thing information that they really have is your credit report, and your credit report only has 6 years history on it. I don't know where the information about your repossession would be, to be honest. I don't feel it would be, but yeah, I don't think it would be, but I'm not 100% sure. As far as I know, when they're doing a credit check on you, and that's the closest thing I could think of, they only go back 6 years. Um, I've got 3 months to accept. I've got 3 months to accept. So they want letters of everyone lending me money. Right. Okay. Yeah. That's the thing. If you say lending money, that will decrease your affordability. If they're gifting it to you, then it would be that's a better position, because the way it works is it's just a gift and it doesn't affect your affordability. If you're asking people to lend you money, then it is going to reduce your affordability. So it's kind of, you're in the exact same position as if they hadn't lent you money, if you get what I mean. So you're better off gifting. If it is gifting, then it's basically you might have a donor letter, and they might want to see where the funds came from. So they will want to check that out. No problem. I'm happy to answer. Are there any benefits? Pay 5% deposit instead of 10% when purchasing a property. Are there any benefits of paying a 5% deposit instead of a 10? Right. So I assume this is for someone that isn't on a right to buy, and they're just purchasing, they're a standard first time buyer. If you're putting down a 5% deposit as opposed to a 10% deposit, you will be in a different interest rate bracket. So the mortgage deals you'll be looking at won't be, there's mortgage deals for people with 5% deposit, and there's mortgage deals for people with 10% deposit. So interest rates are slightly higher for 5%, because at the end of the day, the bank is lending you 95% as opposed to 90%. So there's more of a risk factor. So the interest rates will be slightly higher. The other thing, and it's not just the interest rates, it's the booking fees, the mortgage booking fees and things like that as well. Basically, I would put down as much of a deposit as you could as a first time buyer. That's the best way to explain it. How's affordability really worked out? Is there an amount, we'll say, not to live on. Yeah, I mean, at the end of the day, it really does depend on the lender. I've got a system that works out affordability for about 47 different lenders, and they all come out differently because one, they slice income differently. Some will take all of your bonuses, some will take half of it, some will take all of the commission, all of the overtime, some of it. Some obviously put in the cost of living higher than others, sometimes stress test a little bit more than others. And the stress test is basically whatever the interest rate is plus 1-2%, because they're trying to put in a buffer. If the interest rate goes up, will you still be able to afford it? But so many lenders have so many different ways of slicing it. I know one lender that literally bases it on what your pay slip is. So based on your net income that they know you're going to get every month, as long as they know that, you know, your mortgage payment compared to your actual net income, then they base it on that. So yeah, it's a hard question to answer. That's why, again, it's good to go to a mortgage advisor, because you can say, some people, they literally do not care what, well, not care, but they're less concerned. It's not a priority what the interest rate mortgage deal is. It's more of a priority to get the maximum lending amount. So you can base things on different criteria, because some lenders, the interest rate won't be as competitive as some of the others, but they will lend you so much more, and vice versa. So you've really got to know what your priorities are. And yeah, mortgage advisors, having conversations with them can help that. Um, sorry. Oh, right. Where are you located? Right. As I've said to a couple of people, I am London based, but the way I work, I do mortgages for anyone within England, and the way I work is virtually. So we can go on a Zoom, or we can do a call or WhatsApp or whatever works for you. I don't do face to face. I do everything virtually, and everybody scans their documents or takes photos of their documents, and we kind of work that way. So I've worked virtually for the past 4 years. So that's the way I prefer to work. Um, Right. How far in advance before viewing would you suggest getting a mortgage advisor in place? Again, it depends how much work you need. I would have initial a conversation, and that's what I've done with all my clients. Have initial conversation, and we see how much work they need to do. Because I've been in situations where people haven't got their mortgage advisor till they've pretty much, need the mortgage, and I've looked at their credit reports, and I'm like, do you know what, you actually need to do a bit of work on this, and it can take up to 6 weeks to have a positive effect on your credit report. So if we did get together 6 weeks ago, what I could suggest they implement at that point would really, really help the mortgage application. So I would say sooner rather than later. I mean, you don't have to instruct the mortgage advisor straight away. You can have the initial conversation, which is what I do, and I work out their affordability, and I look at all of that first, and I give them a bit of advice. And then if they decide they want to do a mortgage with me, that's when we're officially working together. But up until that point, I'm just being helpful. So, not all mortgage advisors are going to be like, we will not speak to you unless you pay X amount up front. I mean, that's not the way I deal with things. So I think, the sooner the better on that basis. Okay, I haven't had a response from my housing, but I've had an inspection today for Right to Buy. Yeah, again, there's just a backlog. There's just a backlog. I don't know how else to. Should I now start to look for a mortgage without knowing? Um, it's not looking for a mortgage. You'd contact a mortgage advisor because you want to understand what you need to do to get mortgage ready. You don't actually need to know the exact loan amount that you'll need. That will come a little bit later, but it's good to know what you can afford. And then as soon as once you know what you can afford and what you need to do to improve your ability to get approved by the lender, that is all work that you can do well ahead of actually knowing what A, what your discount is, and B, you know, what the mortgage you're going to need is. And the other thing is, once you know what you can afford, you can be like, okay, I think I'm gonna need to see if anyone can give me some money, or I might have to pay off a few credit cards or a loan or whatever. Because at the end of the day, the multiples and the way it works, looking at the affordability, taking your income and your credit commitments, it's sometimes better to pay off a credit card or a loan, or car finance or a payday loan or whatever ahead of time, and then have it clear. Because like, if you pay a credit card off today, it's not going to show up for maybe 4 weeks, because of the credit card statement. Some people, they can't produce credit card statements like that. They need to actually have the credit card, and then if the lender says it has to show up on the credit report, it can take up to 6 weeks to show up on the credit report. So sometimes it's definitely worth doing that a little bit earlier. So yeah, it's not about a quote for the property, it's about getting yourselves mortgage ready. Yes, it is all about affordability, and as I think I've kind of gone through, there are different benefits, and some lenders will use 100% of the benefits, some will use only 100% if it matches earned income. So there are so many different circumstances, and yeah, again, it does all. There are mortgages that will use benefits, special and disabled benefits, as part of the affordability for the mortgage. The only thing I can be 100% sure on is any housing element won't be included, because obviously when you no longer are on housing and you are now a homeowner, so once you complete, you're considered a homeowner, all housing benefits, so be UC universal credit, the housing element will go away. Any other housing benefits you get from any other source will also go away, but all the other benefits should still stand. So lenders accept that, and they're like, okay, whatever benefits will stand going forward for the foreseeable future, we will use for affordability. So I hope that helps. Okay. Yeah, someone said it's been really helpful. They're planning on starting first time buyer journey in March. I have got a course coming out on it. Of course, bear in mind, as I've said to a few, as I've already said on this video, wait until March could affect your stamp duty exemption. So if your property is going to be more than 300,000, you need to sort of bear that in mind. Okay. Right. Do I know? Right. So do I know any lenders who offer? Yes, I do know, not guarantor, but definitely joint borrower sole proprietor. So, or they've got sole borrower joint proprietor. There are some combinations. To be honest, it's best if you DM me and I can understand your circumstances. But what a couple of lenders, and it's only a small handful, are saying that the people going on the mortgage doesn't necessarily have to match the people going on the deed. So for affordability purposes, you might have a different number of people going on the mortgage that are going on the deed. So that can work for affordability, and it can also help with first time buyer stamp duty exemption and stuff like that. And also later on down the line, inheritance tax and other taxes. So hopefully that's good. Yeah, I mean, right. So again, some people who've applied for the right to buy, but they didn't receive any outcome yet. I think you just have to wait. By all means, if you've got a specific question, DM me. That's not a problem. Okay. Right. Yeah. Anyone who has any questions for me specifically, please just DM me, and we can kind of go from there, talking about yeah, the mortgage process and everything. Okay, cool. All right then. Well, thank you so much for everybody's time. Again, as I said, I would love people to go on the course that I've the workshop series that I've done, because it does answer all these questions and more in a lot more depth, and it will give everybody such a better understanding. And again, as I said, the course is £99, but what how I do it is the fee I charge for doing a mortgage for you will be deducted from the £99 will be deducted from that. So you win either way, really. So I hope that's really, really good. And yeah, thank you for your time and have a good evening and happy new year. All right, take care. Bye bye.